Hey everyone, this is Matt with Real Data. Welcome to my channel. Loan Officer 1710619. I do loans in Illinois and Florida. I don't do too many of these videos. I'll post them every now and then, but I just wanted to give everyone insight on the Federal Reserve and the current interest rate debacle. So we'll start off first with the Federal Reserve. Obviously, we know that they're trying to catch inflation. They're trying to tell us that this is all transitory. And I caution everyone that's a little bit unsure or doesn't know what's going on. I think one of the best economists, he's a little bit more old school, John Williams, shadowstats.com. I would recommend that you guys go on and visit his website and what he talks about. He's on YouTube every now and then. And first and foremost, since the 80s, when we talk about CPI numbers, we're not equating house and energy prices. So when we're talking about 8% inflationary rate, throw that out the window. That's complete garbage. If you factor in housing, whether it's mortgages or rent, and then obviously gas prices, electrical prices, we're probably at 15 or 16% inflation right now. So the common theme for me is we're never going to catch inflation, and the higher the energy prices go with diesel and fuel prices, it's going to take people out of business, and essentially it's going to exacerbate the economy. So what I'm thinking is, if they do another rate hike of 50 basis points or 75 basis points, I think that's going to be it. And then they're going to either stall for another 3 to 6 months, or they're going to take a backtrack and slowly reduce interest rates as we saw in 2018 and 2019 after the stock market started cooling off. So if we go back to the data, 2018 and 19, even when Trump was in office, the stock market started cooling off. What we usually don't talk about, there is a plunge protection team, PPT, and that's essentially the government comes in, puts in inflationary or invisible money into the stock market and props it up. So that's one thing, the news media is not going to really talk about. So the market's been getting, meaning the stock market's been getting inflated by the government. And then obviously COVID came, stimulus checks were given out, free money, interest rates dropped to its lowest levels and since the inception practically for lending on vehicles, mortgages, and anything else that we could think of. So when we put all this into play, the higher they go with interest rates, and we're still creating money out of thin air. We're printing money. Now we're sending money to Ukraine. We're sending money for COVID, which was, I think, $5 trillion. Nobody knows where the money went. All this money has to be equated for. So if the taxpayers are going to be responsible for that, there's also other avenues such as mortgage-backed securities where the Federal Reserve and other private investors are actually buying up this debt. Not to mention Japan and other countries in Asia are actually buying up our debt too. At some point, if that stops or the rates get too high, the ability to repay is also going to come into the equation, right? And as far as when we have these mortgage loans that are not A paper, how many investors are going to want to purchase these with a lesser down payment, for instance, a higher interest rate, and more of a risky loan, knowing that if the market slows down, there's going to be a risk of unemployment. There's going to be a risk of, again, inflation that they cannot catch up to. So with the Federal Reserve, I think they're going to be stuck if they decide to do one more rate hike. And after that, I really feel we're going to level off. As we're recording this, the stock or the Dow Jones is at 29,000. S&P is at 3,600. I'm anticipating that if the S&P drops to 25 or 2,600, that's going to be a shock to the Federal Reserve, and I think they're going to start backpedaling. So that's just my prediction. I think if they go above that, they're essentially going to crash the market at that point. The next thing, the interest rates. So If we're looking at the 10-year treasury, which was about 3.4 yesterday, it dropped to, I'm looking at it right now, it's 3.195. So even though we had the Fed interest rate of 75 basis points yesterday, the interest rates actually increased or improved today in response to mortgage lending. So there isn't a direct correlation, but if you want to be on top of it, the 10-year treasury is usually a good indicator. When it drops, so do the mortgage rates. When it increases, the mortgage rates usually increase. The other thing that we don't equate is when the Federal Reserve raises the interest rates. So right now the benchmark is 1.5 to 1.75. That's usually where the banks get their money from the Federal Reserve, and they get it for about that rate or maybe at a discount. The 30-year interest rates today are anywhere from 5.375 and up, for instance. That means the banks baked in have about 3.75 to 3.875 wiggle room. So the other thing to keep in mind is if the Fed raises the benchmark another 3/4, it doesn't necessarily mean that the interest rates are going to go up that much higher. You know, the 30-year may get to 6%, maybe 6.25%, but I don't anticipate that we're going to get in the sevens. If we get that high, it's basically going to not only fluctuate the real estate market in a negative territory, it's also going to drastically slow down the stock market. Because if you think about it, the real estate and lending is very correlated with the rest of the stock market, right? We could talk about Lowe's, the Home Depots, all the construction inventory right now. Everything is based on, is the inventory moving? If rates get too high, even though we have a short inventory for new construction, you're also going to be slowing down that environment, and then you're going to get discounts at new construction. And I don't know at what margins the developers are working with. The other thing to keep in mind, record prices, even though they've dropped maybe 10 or 15% in the last month, is copper. Anything that's done electrical, you have to equate that in. In my opinion, also for the next 5 to 10 years, anything from uranium to precious metals is likely going to rise, and that's not based on the inflationary period. That has to do with the money creation, and that's basically going to reflect within a year, 2 or 3 from now, where everything just gets more expensive. So with the new construction, if the prices start to plummet, 5, 10, 15%, the developers are going to be hurting. So all this at the end of the day is correlated. That's what you want to think about. When the real estate market moves and the lending moves, that means the banks are making money, the large retailers are making money, and the economy is flowing. Anything from the nuts and bolts to drywall, sheeting, anything you could think of, it's very, very correlated. The last thing I was going to mention is the 10-year. The 10-year's at 3.19. I predict that if the 10-year gets to about 4%, we're going to have a lot of issues with the interest rates. So again, I think they're going to be backpedaling between the third quarter and the first quarter of 2023. I'm also predicting that probably by next quarter, we're going to have a slight recession that may lead to more, and that's going to be dependent on what the Federal Reserve does. Lastly, conclusion, I would recommend, if any of you are interested in the Federal Reserve, as I'm not a fan of them, I don't think that they're actually federal. It is a private entity. I would recommend to read The Creature of Jekyll Island by G. Edward Griffin. There's other books about the Federal Reserve. Ron Paul has written a book. And the reason I'm touching on this, and a lot of loan officer or mortgage lenders or even realtors, they don't talk about this because it's a little frowned upon, and I'm not trying to attack them, but what this entails is there isn't a free market economy anymore. What happens is if it goes up or down, they're essentially manipulating the interest rates. And the way the market should work, if any of you are fans of Austrian economics, for instance, there should be a free market where if the housing gets out of hand, the demand obviously stops and the prices come down and it levels off. But it cannot be done by an entity that is basically clicking a button and then controlling the market their way. It just doesn't work that way. So until the full economy gets control over a free market economy, I think you're going to continue to see bubbles from anywhere from 5 to 10 years. If you look at precious metals, for instance, they've been holding up pretty good. The youngsters, for instance, they're in cryptocurrencies. They have dropped and they're correlated like the stock market, for instance. So in these times, people don't know where to put the money in. The savings or the savings accounts or CDs are actually paying less than what the inflation is. So people are a little bit confused. What do? The majority of people in 2020 and up have been gamblers in the stock market. And I'm going to call them gamblers because they're not investing anything like Berkshire Hathaway long-term or any blue chip stock that pays a dividend. They're putting money in AMC and other stocks that literally could go up 100% or drop 100% in the span of 2 weeks. So what we're seeing here is the economy is forcing people to put money in the market, and that goes from young people to old people that are now retired, because the savings is obviously eating into, or the inflation is eating into their savings, and they're forced to reintroduce their money into the market versus before, they would be semi-retired at this point. So all this is going to, obviously, the chicken's going to come to roost at some point, and I think that that's when they're going to have to backpedal, because at the end of the day, there's so much money that's printed that it's unescapable, basically. So the more they raise the rates, and until we get the gas situation figured out with oil, if diesel keeps going up, we're not going to catch this inflation. We could literally see this go past 20%. So at some point, I think they're going to finally tell people the truth, and they know what's going on, but they're not telling us. They're going to say, all right, we're going to stop here, and then it's going to be stagnated for probably 4 to 6 months. And if the economy's still not picking up, they're going to go backwards like Japan. So hopefully, I hope you guys found this video instructional and helpful. And if you have any questions, I'll forward you the contact information below. And I wanted to say thank you for attending this video.